Howdy, Jacob here. Today we're going to be looking at Dine Brands Global, ticker symbol DIN. All right, so first things first, 4.42% dividend yield. Looking like a pretty cheap PE. Negative price to book. Looks like they got a lot of debt quickly just from quick view. And you can also see that up here, $713 million market cap with 1.7 billion enterprise value. Let's look at that balance sheet, capital leases, I presume, and also debt. All right. So here you can see book value is negative 300 million. Let's see how much debt this actually is. So 1.2 billion in long-term debt. That is a lot. All right. So that's 12 times. We can assume if we average this out, maybe a little over 100. But with that said, if we compare that to the dividend of 32 million, they can definitely afford that. Let's see if they've been okay. They increased it pretty consistently until right here. Must have been a big write-off in 2017. I think we can start making some assumptions here. So something like this. It's a hotel, restaurants, and leisure. They own IHOP, Fuzzy's, Applebee's, just fantastic spots. Who doesn't love a dollar margarita at Applebee's and Fuzzy's Margs? Wonderful. All right, so some like this probably not going to grow more than inflation, and with that, probably a pretty conservative terminal PE and price to free cash flow. However, there is a lot of debt here, so I might add an extra margin of safety. I presumed it'd be pretty heavy in capital leases, but the long-term debt alone is 1.2 billion. So I might go upwards of 17.5, get a little extra meat off the bones before truly feeling confident here. And then, this is a business that likely is a little bit affected by. IHOP and Applebee's aren't bougie places, so they might not get too hurt in downtimes, but I can't imagine them, improving. Not like a McDonald's or something where it's known to be cheap, even though McDonald's is now super expensive. But I think margins, net income, let's just say roughly 9%. Free cash has always been higher or consistently higher. Maybe throw 10% in there. Let me do 8 and 9 because with that interest rates rising on so much debt, that's going to affect them pretty heavily. If they have 2% increase on 1.2 billion, that's 12, 24 million. That's definitely a solid impact on their margins. So I feel good about that. Share change looks like they've been buying back shares pretty consistently. I think I'd like to see them buy a little bit of that debt down, but um, with a P of what was it 9.5, probably not a terrible idea to be buying back shares. Um, Maybe -3. They've been buying back a lot of shares. So, all right, let's see what we got here. Oh, let me increase this dividend here. So, like I said, they're paying out 30 million. They can easily afford that. I might just bump it up 3%. Just say they're gonna bump it up with inflation. And let me do 2%, just under inflation. What I think inflation could be, and that still gets it needing to drop 20% with all these assumptions. Something like this, if you can understand the debt in these areas, it might make more sense to not be so conservative on the discount rate. But me personally, I just see a lot of debt and I get scared in the fact of maybe they can't pay it off. There's so many things that could go awry with over 12 times your free cash flow in long term debt. But I hope everyone has a good rest of their day, and thanks so much.